Hello guys. Welcome back to our channel. This video will discuss 8 value stocks you should consider investing in for passive income. Before starting our video, if you are new to our channel, please subscribe to our channel and press the bell icon for more regular updates. The following is a list of the most important financial institutions in the world, along with information on each one. So, let's start today's video. The stock market is in a terrible state. However, ongoing selling has produced increasing possibilities to purchase companies at attractive prices. Numerous individuals have lamented the absence of precious stocks in recent years. However, there are currently countless high-quality options available for this summer. Here are 8 the best value stocks to buy. Number 1. Wynn Resorts Limited. Numerous value stocks have a glaring issue or headwind that causes shares to be discounted. The difficulty for gaming business Wynn Resorts is its exposure to Macau. Wynn has made substantial investments in this region, and as a result, it remains under pressure from COVID-19. As China has maintained more stringent COVID limitations than many other jurisdictions, it is unclear when Wynn's core revenue-generating assets will return to normal. Wynn might be an excellent pick for bulls on Asian consumers or those seeking an economic recovery play. Before the pandemic, the company often earned more than $5 per share yearly, so if Wynn could return to pre-COVID levels of profitability, the stock price would be just 12 times earnings. Dan Wasielek of Morningstar has set a price target of $109 for Wynn, indicating that shares are trading at a significant discount around the $60 level. Number 2. Altus USA Inc. Altus USA has several significant risks. The corporation has substantial debt, and analysts are usually dubious of its capital allocation decisions. These concerns have made ATUS one of the top bargain stocks to purchase right now. Altus USA is an industry leader in the cable sector. This year, cable stocks have been subjected to intense pressure as subscriber growth has stagnated or, in some cases, turned hostile. However, these assets still generate a substantial cash flow and provide an essential service to consumers. Altus is investing extensively to update a significant portion of its network to fiber rather than continuing to use traditional cable. If successful, this could improve Altus's financial situation. Michael Hodel of Morningstar assigns Altus USA a fair value of $28, representing a roughly threefold rise from the stock's May 10th closing price of $10.01. Even a partial return to $28 would be advantageous. Number 3. CitiGroup Inc. The decline of banks continues despite the increase in interest rates. Typically, investors anticipate a rise in bank stock prices in response to increased interest rates, as higher rates can result in more significant profit margins from lending. However, credit risk and economic concerns currently appear to outweigh the pros. CitiGroup, in particular, has fallen below the $50 level, and its dividend yield has been above the 4% criterion. Unbelievably, share prices are only 7 times this year's expected earnings. It is also trading for only 0.5% above its book value. Historically, it has been wise to purchase large American banks at a considerable discount on their book value. Citigroup's Eric Compton has a price target of $78, representing a 60% increase from the closing price of $48.75 on May 10th. Number 4. Global Payments Inc. Currently, the payments industry is a wasteland. Everyone has been burnt, from fintech companies like PayPal Holdings Inc., PYPL, to traditional processors and merchant acquirers. Global Payments is undoubtedly the most alluring deal in a market saturated with sales. Historically, Global Payments has developed both organically and via astute acquisitions. This expansion has persisted in the present economic climate. In 2022, analysts anticipate revenue growth of 9% and earnings growth of 17% for the company. The company's market capitalization is only 12 times its projected forward earnings. Despite GPN's robust expansion, the stock has decreased by 40% over the past year. There is nothing unique about Global Payments Company that could explain this precipitous decrease. Brett Horn of Morningstar maintains a $186 fair value target for Global Payments, making the May 10th closing price of $118.93 a tremendous bargain. Number 5. Anheuser-Busch InBev SA. Anheuser-Busch InBev has returned to expansion. Anheuser-Busch has struggled to build its business organically for years but is gaining momentum. The company's revenue increased by 11% in the first quarter, driven by 8% price increases and a 3% increase in volume sold. This demonstrates the company's resilience in its ability to withstand inflation. Despite competition from craft brewers and other microbrewers amidst an unstable economic climate, Anheuser-Busch maintains its position. With sales increasing, earnings should also increase. The current valuation of Bud stock is only 17 times the anticipated earnings for 2022. Anheuser-Busch is a relative value in light of the recent ascent of other consumer staples businesses. Philip Gorham of Morningstar estimates a fair value of $90 per share, a 60.0% upside for Bud stock. Number 6. Sabre Corp. Sabre is one of three major businesses that operate airline ticketing software. Sabre, Amadeus IT Group, and Travelport Worldwide Limited control practically the entire global market for these services, except China. Generally, oligopoly sectors with minimal possibility for new competitors are favorable investment opportunities. Sabre and its competitors can charge a tiny tax on most airline ticket purchases worldwide. The company ceased to operate during the pandemic. However, if global airline traffic continues to recover, Sabre should be able to recover. Before the epidemic, the stock traded for more than $20. Dan Wasielek of Morningstar has a $15 fair value objective for Sabre shares, roughly quadruple the May 10th closing price of $7.50. Number 7. Adobe Systems Inc. Digital media, publishing, and advertising software company Abode is off to a rough start in 2022, with shares down 30% year to date. Adobe's services tend to be sticky, so the company shouldn't suffer much of a drop in consumer demand despite the slump in the tech sector. Adobe was not merely a work-from-home occupation. The company's secular growth drivers remain robust, but its shares are caught up in the industry-wide decline. Remarkably, Adobe's stock price is only 29 times predicted earnings for 2022. This may not be a value in the classic sense, but it is shallow for a top-tier software company with double-digit revenue growth. Adobe is a company to watch for investors seeking to profit from the software downturn. Dan Romanoff of Morningstar places Adobe's fair value at $615 per share, leaving more than a 50% upside from Adobe's close on May 10th of $303. Number 8. Zimmer Biomet Holdings Inc. Zimmer Biomet is a renowned manufacturer of medical devices. It is well known for items such as hip and knee replacements. During the pandemic, the company's business slowed significantly like that of other medical device manufacturers. This resulted from the fact that many individuals delayed elective procedures and several hospitals reserved beds for COVID-19 patients rather than surgery patients. ZBH's most recent quarter had constant currency revenue growth of 7% year-over-year compared to the previous year. While business is increasing, medical equipment stocks have not yet experienced a comparable upturn. Zimmer shares continue to trade near 52-week lows and are valued at just 17 times this year's anticipated earnings. Debbie Wang of Morningstar places fair value at $175, leaving more than a 50% upside from its May 10th closing price of $114.17. So, this is all about for today. I hope you enjoyed the video. Kindly subscribe to our channel now and press the bell icon to get more such regular updates.